Now that we've gone over some general options terminology and we've gone into detail about what buying a call option is and what the benefits of buying a call option are, I do want to go over buying a put option. Now we understand that you can buy and sell both call options and put options, and that's where things get complicated. A lot of people look at all of these different strategies out there and think, man, I can never understand. Well, all you have to understand is you can buy and sell, and there are call and puts. Once you understand the basics, you can build on top of that as much as you want and get advanced as you want. But as long as you understand the basics, you will absolutely be able to succeed in options trading. So in this video, we're going to go over why you would buy a put option and what it means to buy a put option. So if it sounds like something you're interested in, let's get started. What's up, everybody? I'm Clay. I'm here to make 2022 the best year ever. If you haven't clicked that subscribe button, make sure to subscribe to the channel. Join us, become a bro. We are here every single day, and we are growing our portfolios together. And look, if you're brand new to investing, you don't know how or where to buy stocks and crypto, you got a link in the description below for Webull. It is super simple to set up your account. Any deposit, you guys are getting 6 free stocks. $1 crypto trades, you're going to get $5 in free crypto. And it is an excellent place to buy and sell stock options as well. So if you guys are interested in stock options, as soon as you're ready to make your first trade, absolutely, you can sign up for the platform using the link in the description, and they've got a great platform for buying and selling stock options. But I want to talk about put options in this video. Now we know, sorry, my eyes a little watering a little bit there. Now we know that buying a call option gives the buyer the right to call a stock away at a certain strike price and at a certain expiration date, or by a certain expiration date. A put option is the opposite. A put option gives the buyer the right or the option to put that stock to somebody else. Now, put is simply a synonym for sell. It gives the buyer the right to sell that stock to somebody at a certain strike price by a certain expiration date. Now, why would anybody want to do this? You would buy a stock option if you believe the price of a stock is going to fall. Now, just the same as call options provide both leverage and protection, put options do the exact same thing. So if you expect the stock price to go up, you are going to be buying a call option. If you expect the stock price to go down, you are going to be buying a put option. Now, I know it's a little tricky to understand why would I buy something if the price is going to go down, but a put option gains in value as the underlying asset or the underlying stock falls in value. Because, remember, and we're going to go over an example here, the buyer has the right to put that stock or sell that stock to somebody at a certain strike price. So let's use AMC Entertainment as an example. Everybody loves AMC stock, right? So if AMC is trading at $20 per share, and let's say you believe that the price is going to go down. So you want to buy a put option. Let's say $19 is the lowest you want to see AMC Entertainment go. So you would buy a put option at $19. Now, what does this option say? If you buy a put option at $19, you are saying, I can put, and we'll talk about expiration later, but let's talk about strike first. I can put this stock or sell AMC to somebody at $19 per share, regardless of what AMC is trading at during any point up until the expiration date. So let's say that you buy a stock option that expires at the end of this month, and it's for the $19 strike price. Well, let's go over a couple of scenarios here. If AMC is trading above $19 at that point, you are not going to be able to put that stock to somebody at $19 per share. You wouldn't want to sell it to them at $19 a share when you could sell it to them on the open market at $20 or $21 or $25 per share. So it's going to expire worthless if the stock price is above the strike price at expiration. You want the price to be lower because remember, you are selling it to them. You always want to sell higher as opposed to lower. So if AMC is anywhere above $19 at expiration, you would rather sell AMC on the open market for $25 as opposed to $19. Now let's say that AMC has some terrible news and it drops in price all the way down to $3 a share. You've got a financial contract. This stock option that you bought is a financial contract to sell AMC at $19 per share at any point in time. Remember, the strike price is 19. You can sell it at the strike price at any point in time up until the expiration date. So what you can do is you can go out there, AMC's trading at 13, but you've got a financial contract that says you can sell it for 19. So that is an amazing difference. You have protected yourself from any downside movement in the underlying stock that you own. You don't have to worry about selling it at $3. You can go sell it at $19. And that is very valuable. That's a difference of $16 per share. So let's say that you weren't even holding AMC, but you believed the price was going to go lower and you bought a put option. You can still sell that put option for at least the intrinsic value of $16 per share, or because every single contract controls 100 shares, that is $1,600 minimum that you could sell that put option for. And you have that option. You have that choice to do it. Remember, call options and put options trade on the open market, so you never have to exercise them. In fact, very few options ever go exercised. They are typically bought and they are typically sold, but they are not typically exercised. So if you're looking at that put option and you know it's worth $1,600, you can absolutely go out there and sell that for $1,600 just by clicking the sell button. It is that simple to do so, and it has that profit associated with it, and it has that value associated. So you could sell that and never have to worry about, selling or putting your shares of AMC to somebody else if you want to continue holding them. So you are allowed to buy a put option even if you don't own the underlying security, and you are allowed to buy a put option if you do own the underlying security. You are allowed to sell that put option at any given time, and you never have to exercise, the same as a call option. You do not have to exercise, and you can absolutely sell them for those profit. So we can see the leverage in this situation and how much money can be made, but also look at the protection there. If you were owning AMC at $20 a share and you were afraid that it was going to drop in price, you bought that put option. Think of it as an insurance policy. If you're buying a put option and you own the underlying security, you are guaranteeing yourself a minimum price regardless of the price action that goes on, because you can always sell those shares to somebody else at the certain strike price that you agree upon. That is part of the protection. And a double-sided part of protection that I want to briefly talk about right here is the advantages of buying a put option as opposed to shorting a stock. If you are going to buy a put, you want the stock price to go down or believe the stock price will go down. If you are shorting a stock, you want the stock price to go down or believe the stock price will go down. So essentially, you're doing the exact same thing. But what's the difference? In a put option, you are able to limit your upside or limit your downside risk, but limit the risk of the stock going to the upside. So in a put option, you can never lose more than the premium that you pay. And the same stands for a call option as well. You can never lose more than the premium you pay. So if you paid $100 for that stock option, the most you can lose is $100. And that's if it expires worthless and your expiration date comes and the put option or the stock price is either above the strike price, or if you have a call option, the option or the stock price is below the strike price. But nonetheless, the maximum risk associated with a put option is the premium paid. And this is excellent because if you were to short a stock and that stock were to rise indefinitely, you have indefinite risk. You can short a stock at $1 per share, and if it rises to 100, you owe $100 per share. You have unlimited risk if you are shorting a stock, but if you are buying a put, you have limited risk. So there are the advantages, there are the pros and cons, to both buying call options and buying put options, and those are leverage and protection. So guys, I want to know if you have any more questions about put options. Let me know down in the comments below if these stock options are something you're interested in, or if you have any questions or concerns, please let me know. And of course, if this button right here is still red, make sure to click it, subscribe to the channel, join us, become a bro. We are here every single day, and we are growing our portfolios together. You guys got ClayBro883 on Twitter and Instagram. You got 6 free stocks on Webull in the description below. There's also a Discord down there. It is absolutely free. Make sure to check that out. And until the next time, hope that each and every one of you have an awesome day.